In 2024, the S&P 500 companies paid out over $580 billion in dividends to shareholders, and the people who understood how that money moves quietly built wealth while everyone else watched the market chase the next hot stock. Most people think dividends are just a small cash payment a company sends you for owning its stock, a nice bonus, a little thank you note in the mail. That understanding is so shallow it's almost dangerous, because it causes investors to completely ignore the single most powerful wealth-building mechanism in the history of public markets. Dividends are not a bonus. They are the actual proof that a company is generating real cash, and the investors who understand how to read them, collect them, and reinvest them are the ones who quietly end up owning the entire board while everyone else is gambling on price charts. Here's what makes this urgent right now. Interest rates have been elevated, inflation has shredded purchasing power, and the average person saving for retirement is getting maybe 4 to 5% in a high-yield savings account if they're lucky. Meanwhile, established companies like Johnson & Johnson have increased their dividends for over 60 consecutive years. Coca-Cola has done it for over 62 years. These aren't speculative tech startups. These are boring, cash-generating machines that have survived recessions, wars, and pandemics, and they keep sending you more money every single quarter. The gap between the people who understand this and the people who don't is the gap between financial independence and working until you physically cannot anymore. Let's start with what a dividend actually is. When a company earns profit, it has a choice. It can reinvest all of money back into the business, or it can distribute a portion of it to the people who own the company, the shareholders. That distribution is the dividend. It's typically paid quarterly, and it's expressed as a dollar amount per share. So if a company declares a $1 quarterly dividend and you own 100 shares, you receive $100 every 3 months, $400 a year, just for holding the stock. But here's where most people stop learning, and that's exactly where the real story begins. The number that actually matters is the dividend yield. That's the annual dividend divided by the stock price, expressed as a percentage. If that same stock trading at $40 pays $4 a year in dividends, the yield is 10%. That yield tells you how much cash flow you're getting relative to what you paid for the asset. And this is where serious investors start paying attention, because a high yield can signal either a bargain or a trap, and knowing the difference is everything. A company's payout ratio is the percentage of earnings paid out as dividends. If a company earns $5 per share and pays $2 in dividends, the payout ratio is 40%. That's healthy. That means the company is keeping enough to grow, pay down debt, and weather storms while still rewarding owners. But if a company earning $2 per share is paying out $3 in dividends, that payout ratio is over 100%. The company is literally borrowing or burning cash to keep the dividend alive. That is a red flag the size of a billboard. And yet thousands of retail investors keep buying these stocks just because the yield looks attractive, not realizing they're watching a slow-motion collapse. Now let's talk about why serious investors obsess over dividend growth, not just high yield. A company that grows its dividend year after year is telling you something profound without saying a word. It's telling you its business is durable. It's telling you management is confident in future cash flows. It's telling you that even when the economy contracts, even when consumers pull back, even when supply chains break, this company finds a way to generate more profit and share it with you. That's why dividend aristocrats, companies in the S&P 500 that have raised their dividends for at least 25 consecutive years, have historically outperformed the broader market with lower volatility. The data from firms like N. Davis Research and S&P Global has shown this repeatedly over decades. And then there's the compounding effect, which is where dividends stop being boring and start being almost unfair. If you take those quarterly dividends and reinvest them, buying more shares, those new shares then generate their own dividends, which buy even more shares. This is dividend reinvestment, and over a 20 or 30-year horizon, it is devastatingly powerful. A study from Hartford Funds found that from 1926 to 2023, reinvested dividends accounted for roughly 40% of the total return of the S&P 500. Let that sink in. Nearly half the wealth created in the stock market over nearly a century came not from stock prices going up, but from dividends being reinvested. The people who understand this don't need to pick the next NVIDIA. They need patience and discipline. There's also a tax dimension most people ignore. In the United States, qualified dividends are taxed at long-term capital gains rates, which are lower than ordinary income rates for most earners. That means dividend income is inherently more tax-efficient than interest from a savings account or CD. For someone building a portfolio in a taxable brokerage account, this matters enormously over time. The government is literally incentivizing you to own productive assets. The mainstream financial media rarely talks about this because it's not exciting. There's no drama in a company quietly raising its dividend by 3%. There's no viral clip of compound interest working in year 17. But the investors who retire with millions are almost never the ones who got lucky on a single stock pick. They're the ones who understood that dividends are the market's way of separating real businesses from hype, and they built portfolios around that truth. So the next time you look at a stock, don't ask where the price is going next week. Ask whether the company is paying you real cash, whether it's growing that payment, and whether you have the patience to let compounding do what it does better than any strategy ever invented.